Today, too late bankers, too late. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, the inflation genie is out of the bottle, and you can, I think, accuse central bankers around the world from coming to this too late and digging a very deep hole to get out of. But reflect on this for a moment. 4 more years for Jerome Powell. The Senate in the US voted 80-19 last week to confirm Jerome Powell for a second term as chairman of the Federal Reserve. That's a bipartisan vote that was actually largely as expected. 19 senators voted against the confirmation, and they consisted of Republicans who weren't happy with Powell's performance on inflation, but also a sprinkling of progressive Democrats like Elizabeth Warren, who objected to him for not doing enough on other things like bank regulation or climate risk. Now, people gave Powell a lot of credit for following the playbook of his predecessor Bernanke when faced with the challenges of COVID-19. Print money like crazy and hope for the best was pretty much the strategy, and it works sort of, except we now have runaway inflation, perhaps due to an excessive amount of money creation. This month, the Fed raised rates by 50 basis points. That's the first hike of such a size in 22 years. And I've certainly expressed concerns about central banks of various flavours just cutting rates and doing forms of QE. In fact, a House of Lords report last year questioned the Bank of England's approach, and the report suggested they were not at arm's length from HM Treasury, nor indeed independent. In fact, the low rates help fund bigger deficits, which will now cost more as rates rise, of course. And in Australia, again, the RBA is clearly not independent from the political machine, as can be seen by the shadowy Council of Financial Regulators, which includes Treasury, among others. Now back to the Fed, though, because there was an interesting interview with Marketplace's Kai Rustal. In the text of that interview, there were a number of, zingers, actually. For example, Powell said at one point, the question whether we can execute a soft landing or not, it may actually depend on factors that we don't control. Powell has insisted previously that the Fed has all the tools to control inflation, for months now actually, so this was a significant comment. Perhaps their tools are not sufficient. And then there was this, when asked if he had acted soon enough to lift rates. If you had perfect hindsight, you'd go back and it probably would have been better for us to have raised rates a little sooner. And remember those months of transitory inflation and allowing inflation to run hotter so that they could achieve their target over time? Target 2%, actual more than 8%. It's not a good result. And other central banks, to varying degrees, have precisely the same problem. Indeed, Andrew Bailey in the UK suggested recently that inflation could go north of 10% and more rate rises were coming. The groupthink among central bankers is extraordinary. Perhaps instead of labelling inflation as transitory and not acting as any sensible central bank reacts when inflation reaches its ugly head, that was indeed a major policy error. And then Powell said that the process of getting inflation down to 2% will also include some pain, but ultimately the most painful thing would be if we would have failed to deal with it and inflation were to get entrenched in the economy at high levels. Question, of course, is it already entrenched? And some pain indeed, not least given the over-leveraged nature of households and businesses. But of course, the question is, at what point will central banks have to revise their current rate-lifting plans, and what will break in the process? But they were late to the party, and getting inflation down will be hard at best. But then some are suggesting it will self-correct. Ben Bernanke, the former chairman of the US Federal Reserve, in a recent interview with CNBC's Andrew Sorkin, predicted that current US inflation, which of course is trending at the highest levels in 40 years, will come down without direct intervention from the Federal Reserve with time as supply chain issues continue to recover. But he said, however, if the Fed is forced to continue tightening interest rates, then there is a higher chance of a nationwide recession. Nevertheless, the former chairman stated that such conditions are difficult to predict. The thing that people should watch most closely is inflation expectations, he said, claiming that a rise in expectations will signal that the market has lost confidence in the credibility of the Fed. And Bernanke, by the way, also touched on crypto, saying he does not believe Bitcoin or other cryptocurrencies can succeed as an alternative money. He claims their prices are too volatile to serve as a practical means of exchange, and that the underlying use case is to serve as a store of value. And Bernanke claimed that cryptocurrencies have been successful as a speculative asset. However, as a substitute for a fiat currency, they haven't lived up to the hype. If Bitcoin were a substitute for fiat money, you could use it to buy your groceries, he argued. Nobody buys groceries with Bitcoin because it's too expensive and too inconvenient to do that. And in fact, Bernanke believes Bitcoin's main use case is within underground economies for facilitating illegal activity. Of course, a popular theory on-chain data fails to collaborate. This Chainalysis' latest crypto crime report showed that illegal activity takes up a smaller share of Bitcoin trading activity over time. And even the Treasury Department recently admitted that fiat is still the go-to currency for criminals, not crypto. And Bernanke added that the price of groceries also regularly fluctuates against Bitcoin, further impeding its adoption as a medium of exchange. Indeed, Bitcoin's price has seen major volatility to the downside over the past 7 weeks, breaking an all-time record for its longest weekly bearish trend on Monday. And Sorkin also asked whether Bitcoin at least held value as a non-transactional store of value or digital gold, and Bernanke rejected that comparison as well. Gold has an underlying use value. You can use it to fill cavities, he explained. The underlying use value of Bitcoin is to do ransomware or something like that. And finally, further on the central bank axis, minutes of the Reserve Bank of Australia's May meeting revealed that the central bank decided to increase interest rates by a surprising 0.25 percentage point because they considered 3 options for the size of the rate increase at the present meeting: raising the cash rate by 15 basis points, 25 basis points, or 40 basis points. The minutes said members agreed that raising the cash rate by 15 basis points was not the preferred option, given that policy was very stimulatory and that it was highly probable that further rate rises will be required. A 15 basis point increase would also be inconsistent with the historical practice of changing the cash rate in increments of at least 25 basis points, they said. An argument for an increase of 40 basis points could be made given the upside risk to inflation and the current very low level of interest rates. However, members agreed that the preferred option was 25 basis points. And the RBA concluded that a 0.25 percentage point move would help signal the board was now returning to normal operating procedures after the extraordinary period of the pandemic. Given that the board meets monthly, it would have the opportunity to review the settings of interest rates again within a relatively short period of time based on additional information. So expect another hike next month in the battle for inflation, one created by central bankers in the first place. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.